Welcome to FO Talks. With me is Sam Tully, a dear friend who has over 30 years of experience in Indian equities. He grew up in India. Indeed, he is the son of the legendary Sir Mark Tully, who was a wonderful conversationalist and an encyclopedia on India. Sam is no slouch either. He understands India better than most people. He speaks Hindi. He has a great sense of humor. And today we'll be discussing a topic that is not so humorous, sadly. We'll be discussing why is foreign capital fleeing India. Sam, welcome.
Welcome. Thank you. Thank you very much, Atul.
So, Sam, what exactly is going on? Paint us a picture.
So I think what you've seen in India over the past 2 years, which started in 2024 and has been going on through 2025, and the pace has been, if anything, slightly accelerated in 26 so far, is that foreign portfolio investors have been taking money out of the Indian markets to the extent of about $45 billion in total. About 18.5 billion in 25, and so far this year alone, $20 billion. And that's
this year, as in 2026.
As in 2026 calendar year, yes.
Yeah. And by the way, we are recording this on June 9th, Tuesday, 9th of June. And so we are still early days yet in 2026.
Yeah. And yes, quite notably, we're not even halfway through the year as yet. So those numbers are pretty substantial. And, you know, I think if you look at the overall extent of, in terms of percentage ownership of the whole equity market in India, the level to which foreign ownership has dropped is also at a decadal or longer low. So those are potentially worrying signals. My own view. Sorry, carry on.
Sorry to interrupt you. The question is why? Why are they leaving? Because for a long time, India was pitched as the India story. Foreign investors piled in for higher returns. You and I have friends who are investors in India, many of them for decades. So what's happened? What's transpired of the last few months that the tide has turned?
Well, I think it's longer than a few months, Atul, is the first thing I would say. But obviously there's been an acceleration over the past few months. And I think that you can actually link very specifically to factors external to India as well as internal. And the situation in the Middle East, in particular Iran and the Straits of Hormuz, is of a particular worry for many countries in Asia, including India, because the extent of the oil that flows through there and the extent of their dependence on that oil and other flows coming through. So I think
very quickly, let me tell our viewers and listeners that the countries in South Asia have no energy. They are low on fertilizers. So whether it is India, whether it is Pakistan, whether it is Bangladesh, whether it is Sri Lanka, they depend on petroleum or oil, crude oil, largely from the Gulf. Yes, some Russian oil can come in, but the Gulf is the big source. Natural gas in particular comes from the Gulf, and that is causing shortages in factories, as well as cooking gas, LPG cylinders, liquefied petroleum gas, which is how most South Asians cook their food. And then, of course, fertilizers. A third of the fertilizers, about 20% of oil and gas flowed through the Strait of Hormuz. A third of the world's fertilizers came from there, and all of these countries are extremely dependent on fertilizers from the Middle East. And so there's a real shock. There's an energy shock. There is an agricultural shock. And you combine the two of them and you get both an inflationary shock as well as a food security shock. Over to you, Sam.
Yeah, Atul, I think you've literally hit the nail on the head with respect to that particular issue. And inflation is a major corollary. And as we know, if there's one thing that politicians particularly in India, do worry about it is inflation. But investors worry about it as well. I would then go back a little bit further. The immediate impact has also has probably been accelerated by these external factors, particularly. But if you want to go back to sort of 24, 25, there's been a few other things that have been happening in India. One of which is that the market has historically traded at very high valuations relative to other markets. And that's been driven by the fact that the growth in India is seen as much higher than elsewhere, which would feed through into earnings growth also being much higher. Actually, what has happened is that the level of growth has been slightly disappointing, and there are a number of reasons behind that. And more importantly, that feeding through into earnings growth has also been disappointing. And this at a time, and this is a key issue, when other markets have been actually improving, and particularly those markets which India competes with in the global emerging market basket, like China, Taiwan, and Korea, who have also had the incredibly important tailwind of AI driving them, which is another reason why investors have sort of said India's expensive. It doesn't have the exposure to the AI hardware that we see in Korea, Taiwan, and China. Relatively speaking, we take some money off the table there and put it into these other markets.
One hears a lot about Samsung's annual profit compared to all the Indian giants together.
Yes.
And that's a figure that's bandied around. Apparently, Samsung's figure alone, 250 billion or 200 billion, was higher in dollar terms, was higher than all the Indian majors put together. That is something I've heard from fund managers. I've also heard repeatedly that increasingly Indian companies have become less competitive globally. They are not as efficient. There has been a massive increase in oligopolies, and even Indian software companies have not invested. They've had a lot of cash, but they've not invested in products. They've focused on services. And we have talked to friends who've explained this situation. Do you think all of these are also factors?
I think they are factors. And one of the key things that you always look out for as an investor in markets, and particularly in India, where you've seen these cycles over time, is a revival in domestic capex. Not just the capex from the government, but also from the private sector, because that also drives credit growth, which is positive for the economy. So it's positive for banks, positive for the markets. But most importantly, it's positive as an indicator that corporates are putting their money where their mouth is and investing in, ideally, in plant and machinery, in hardware and job generative stuff, because that's another factor which we can touch on. Now, historically in India, you had some companies that have invested quite a lot of money, but you talked about the tech companies, and I think it's a very valid point that historically, for various reasons, they've been focused on the service side, obviously, rather than on the hardware. That's the way that the industry developed in India. But they've never really invested in. Excuse me, sorry. They've never invested in products. You're never going to see the next Windows coming out of India. You're not going to see the new AI products apparently coming out of India from these companies, because they haven't invested. They've been quite wary of actually picking up acquisitions overseas that can help them with that. So that is a factor.
So CapEx, it seems from what you're saying, has been low.
Yeah.
And could that be because of the crowding out effect, that there's too much government expenditure, and therefore is, as you know, in economics, there is the crowding out effect. The private sector doesn't have enough capital to invest. Or could that be a reason?
I think there's a number of factors at play. It's partly the way that the capital markets in India have developed over time, it is the case that the government borrowings and investments are quite substantial. But I think that the corporate balance sheets in corporate India in many of the large groups are actually pretty strong. So they really do have the wherewithal to invest if they really wanted to. I do think that they do come across, a number of issues. It's not always easy to put up, big factories, to deal with A, land acquisition, B, labor laws, C, regulation. Whereas other economies, including some in the region, have been much more successful at doing that. And it goes back to one of the other things that just a very few years ago, when China really was almost seen as uninvestable, it was a word that was used quite often. People said, well, India can become China plus one. And it never really managed to do that because structurally, its manufacturing industry, in spite of big government programs like Make in India, has not invested in the same way as you've seen in East Asia, where you've got real powerhouses of manufacturing develop. There are bright spots in India, like the auto industry, and companies within the auto industry, like Mahindra's, for example, and Tata, which are actually, cutting edge in some of the technology that they're applying in EVs, and they are reaping the benefits of some, more capex than maybe some companies in other sectors.
Let's talk about two factors that many of our investor friends talk about.
Yeah,
they talk about demand, collapsing demand in India.
Yes.
And they talk about supply side constraints.
Yeah.
So let's start with the demand side. And I did a long podcast on vegetarian Stalinism in India. And it wasn't popular. A lot of people disagreed with it, but I stand by the argument that such has been oppressive and, more importantly, arbitrary taxation, that demand has evaporated. And when I talk to friends in industry, they constantly complain about this, particularly if they are small and medium-sized.
Yes.
And how far do you think these oppressive policies, and I don't just mean taxation, but for a second, I also want to take you back to demonetization, the imposition of the goods and sales tax in the middle of a financial year with no advance notice. So in the words of many a senior policymaker, particularly those involved in the 1991 reforms, they have told me very openly, very candidly, that we have scored quite a few own goals.
Yeah.
What is your point of view there?
So I think there's quite a lot of points that you've made there. I think
three really: demonetization, number one.
Yeah.
GST, the rollout, not the idea of a GST.
Yes.
And three are oppressive and arbitrary taxation. These are the three.
And those were functions. I think you talked about demand and the collapse of demand, really, on the back of those potential of those three things.
Yeah.
Firstly, I would actually be a bit more nuanced about that, because I would actually say one of India's greatest strengths, and it has many strengths, and let's not forget, it really has delivered for investors over the 30 years since it's opened up. So it's important to make that point. But one of its biggest strengths, which is what has driven a lot of the investor optimism in the past about the market, is the fact that it has a consumption-led domestic economy. It's something that somewhere like China has been trying to propagate for decades, but in India you do have that. So that has sort of helped, particularly consumer goods companies, manufactured goods companies, real estate, and other areas. All of those have benefited from that. The question is that has that engine slightly slowed down or started sputtering? And I would say yes, it has. And I think those factors that you have mentioned there are definitely part of the reason. And then the other thing I would say is, in spite of being seen as a sort of pro-business government, the pace of real significant structural reform to the economy, which you just have to keep on doing, has perhaps slowed more than it might do. And you can understand partly the reasons for that, that ultimately at the end of the day, a government is not always driven by the needs of foreign investors.
Certainly. Now, let us talk about the demand side a little bit further. A lot of these small and medium-sized industries employed people. The people they employed would buy school notebooks, let's say, go out and buy some clothes, or let's say just have chai pani, which literally means tea and water, for those of you who are watching in the US or elsewhere.
Yes.
So the reality is the Keynesian multiplier effect. You're a Cambridge man. John Maynard Keynes talked about the multiplier effect.
Yeah.
When you eviscerate small and medium-sized industries, then you destroy a lot of jobs. And if people don't have jobs, they can't consume. So that element of lower consumption was bound to feed through. Yeah,
absolutely. And I think there are some statistics that really stand out with India. Is if you look at the total employment, it's still around 90% in the informal sector rather than formal. And by formal, I mean those in employed work, registered, paying income tax, etc. A country of 1.4 billion people, I think the number of registered taxpayers is something like 60 or 70 million.
Out of 1.4 billion.
Out of 1.4 billion. So, and even of those registered taxpayers, and that number may be slightly old, but I think it's around the right ballpark. Even of that number, about 20 million or so file income tax returns but don't pay any tax. So the actual number of people paying income tax is quite low, relatively speaking. And that tells you about where we are. And the other incredibly important statistic, which again is a two-edged coin, one of India's great strengths is its demographics. It has a very young population. But if you've got 10 million people, and that's how many you've got, as they say in India, 1 crore plus, 10 million people every year coming onto the labor market, you need to provide jobs for them. Otherwise, there's going to be a problem.
Well, Sam, a senior IAS officer in the finance ministry told me off the record that our demographic dividend has become a demographic disaster.
Yes.
And his own children are obviously in America. So the IAS officers pack off their children abroad. They are in London, they are in Singapore, they are in UAE, or used to be. They are in America. And one of the senior policymakers in Washington, D.C. told me that forget what people say, see what people do.
Right.
How do people vote with their feet? And his point was that talent and capital are trying to get out of India. And that tells you everything you need to know.
Yeah. Now, again, I would say in experience and from what I've heard, that there is a lot of truth in that. But equally, you need to look at the startup ecosystem with some encouragement that you will see young people, very entrepreneurial, attempting to work within the framework that in India provides and operates, often employing cutting edge technology to service the needs of Indians, whether it will be farmers who are getting new data and technology to help them plant as well as market their produce, collectively, whether it's education, new ways of delivering education to kids, and in all sorts of other areas. And the venture capitalists who are being quite successful on that side. So I think I don't want to paint a uniformly difficult picture, because I think that there are many sort of bright spots as well. But structurally, these are issues. And going back to the main point, they are among the concerns, I think, that have driven foreign investor outflows.
So, I mean, the reason I kept going back to demand is if you have low demand, then it means you have low possibilities for market growth. And therefore, if you have low possibilities for companies to increase their sales, then investors look for greener pastures. They may very well invest in Bangladesh that can have better textile factories, or Vietnam where manufacturing does a lot better, or certainly South Korea or Taiwan. Let's get to the supply side.
Yes.
Because I've been told by many business leaders in Maharashtra, which is a manufacturing state. Maharashtra, for those of you who don't know India's geography, is a western state. It is south of Gujarat that just juts out to the west. Maharashtra is a state which has agriculture. It has lots of mini geographies within itself. You have the Western Ghats. To the west of the Western Ghats, things are lush. To the east of them, you have dry land. It is an industrial state. Pune is arguably one of the leading industrial cities in the region. It has the financial capital of India, Bombay, now called Mumbai, which the British got as dowry from the Portuguese. It was a tidy bit of work, Sam. Well done. And Maharashtra has been the industrial powerhouse of India. And numerous industrialists in Maharashtra say it is impossible now to open a factory in Maharashtra because you have to pay off too many people. Getting permission is a nightmare. Dealing with labor unions is crazy. The regulatory burden is just nuts. What do you say to the supply side constraints of just starting and operating a business in India?
I think there is no question that the ease of doing business in India is not quite as easy as perhaps the government might like to think. It's definitely the case that there are a lot of these constraints, but what you actually are seeing is quite a lot of competition within states, basically from within states, to attract investment. And I totally agree with what you say about Maharashtra. I'm a geographer by discipline, and it includes the geographic center of India in Nagpur in the east, which, as you say quite rightly, Atul, is surrounded by a large part of very, very dry and water scarce parts of India with their own sort of issues, and also backward social indicators. But yet it also contains these very advanced and historically very rich wealth driving parts of the economy, including Mumbai. But
very quickly, you mentioned Nagpur. Our listeners should know that Nagpur is the headquarters of the Rashtriya Swayamsevak Sangh, the large voluntary organization that gave birth to the ruling Bharatiya Janata Party. It is headquarters, it is ground zero of Hindutva in modern India.
As exactly as it is the geographic center of India. There's actually a roundabout you can visit in Nagpur where you can see that geographic center. But yes, so it's a very important, part of the country. But if you look, for example, at trying to attract big investment, whether it's from Foxconn or other manufacturers, other states have been actively competing. So Andhra Pradesh on the east, Tamil Nadu has been incredibly successful, and in northern India, states like Haryana have done relatively well, and of course there's Gujarat, which is Modi's own state, which has done well. So I think Maharashtra has actually, for various reasons, fallen behind in the race. But as I understand it, they are trying to sort of make up ground. But I think that these structural issues, whether they're labor laws, whether they're their land, whether they're getting permissions, they have to be dealt with at a combination of state and federal level. And that's where often I think things become a little bit dislocated.
I see. And the reason I raised the supply side constraints is simply, why would anyone invest in a country if there are so many constraints and the competition makes it a lot easier for you to operate? I'll give you an example. Sharat Kumar Saraf is the world's biggest manufacturer of oil drum caps. I have a podcast with him.
Yeah.
And he said that in China, he has a factory in China.
Yes.
If permission doesn't come within a certain stipulated period of time, you're deemed to have permission.
Right.
And the entire focus of the government is, come here, make stuff.
Yeah.
And he said, here we are just waiting for the file. The file ghumti rehti hai, to use a Hindi phrase. Yes. The file keeps wandering. And you're left in limbo. And a lot of industrialists, some of the more literary ones, have told me that doing business in India is like waiting for Godot.
Right.
And yes, we are no longer in the days of the license permit quota Raj, but we are not quite there at what you said, the ease of doing business, which matches competitors. In fact, I have a story about the ease of doing business from one of the IAS officers I ran into at the World Bank, who freely admitted to me, in private, of course, that his job was to game the system, and he was an IITian. So the Indian Institute of Technology, they teach you decent mathematics. And so he freely admitted that they couldn't solve the problem. Therefore, they were doing jugaad the Indian way. Jugaad literally means, innovation, but it has a negative connotation to it. Also means being a bit crooked. And he freely admitted that they were gaming the indices to get India to move up. Now, that gaming the indices might have worked for a bit, but in reality, doing business in India is still difficult. I say that as an entrepreneur. I have thought of opening entities in India, but I've always shied away. And partly it is because of that huge regulatory overload. And it's the arbitrariness. It's more than Germany has red tape. Many countries have red tape. Yeah. England, where you sit, has red tape.
Yeah.
But there's a certain certainty. In India, retroactive taxation, a decision today means nothing tomorrow. All kinds of the arbitrariness of the babudam. That has started to, I think, sputter the economy.
So again, what I can't help but agree with a lot of what you're saying there, Atul. But I would go back to the point that I made, that India, has delivered and it has worked, and you've seen a tremendous, expansion of industrialization of infrastructure. Growth has been, incredibly impressive. I grew up in Delhi in the 70s and 80s. And if you'd said to me that there are going to be 7 or 8 metro lines crisscrossing the city, I would have just laughed. But it's absolutely, and now they've got high-speed rail to neighboring sort of cities like Meerut underway. You just could not recognize the city. So there has been a lot of fundamental change and massive change in regulation. You mentioned the license Babu Raj. I mean, that's a long time ago, but that underlying psychology perhaps is still, there's a vestige of it there. And
look, I can tell you, when I went and joined the Bureaucracy, which was many a moon ago, and then I went and lectured there once, the socialist hangover still existed. There was a belief in the Lal Bahadur Shastri National Academy of Administration that we've cleared the toughest exam in the world. We are the smartest people on the planet. We know better than market forces as to how to deploy capital, how to deploy resources, how to deploy talent.
Yeah.
We are the God-given elite to this country. And mind you, the whole anatomy of the IAS is derived from the Indian civil service, which the British left behind. And when the British were ruling India, policy making was done in London. It was the likes of Lord John Maynard Keynes or John Stuart Mill, who worked in the British East India Company. The chaps who came as Indian civil service officers, the forerunners of the IAS, were just supposed to implement policy and have some inputs. That worked because Britain needed to control every district. And that is why the name collector. You were collecting revenue from every district. But the IAS is singularly unqualified for economic policy making. Let's assume you get in with Farsi literature or Sanskrit literature, or let's say electrical engineering. You've never worked in a business. You don't understand economics. You don't understand supply and demand. And you have this arrogance that you know best. That makes for a very, very, very toxic structure. That's a structural problem. I always ask this question. You go to African countries today, the central banks are headed by economists. You sit in England, the Bank of England was headed by a Canadian, Mark Carney. The Reserve Bank of India is headed by an IAS officer with absolutely no domain expertise.
Well, I would just say on that score, Atul, yeah, I mean, those are definitely, very important observations. But I would say the RBI has actually been one of India's great strengths as an institution, relatively speaking, in the way that they've managed things. But actually, and I don't think it's entirely their fault, one of the other factors, going back to our original discussion of why foreign investors have been pulling out of India, one of the things that has also been a cause of great concern over the past few months has been the rapid decline in the rupee. And that's an interesting one because it's partly driven by this exodus of foreign capital, and partly driven by relative interest rates, and partly also by the way that the RBI has managed that process. Now,
the RBI has been buying, started buying treasury bonds for a long time and didn't buy gold. The RBI has also tried to defend the rupee by selling dollars. So the RBI may have been a great institution in the past, but its recent record has not been top notch.
And on that score, I would also say, actually, one of the structural things within India's stock market that you've really seen, which has actually given an opportunity for the foreign investors to take money off the table without really rocking the boat substantially, is this huge expansion of domestic investors into the market. So they've taken up the slack. When I was in equity sales for the best part of 20 plus years, the first question you would get in the morning meeting was, what was the FII sales yesterday or purchases? And that would drive the mood of the market. But the last 4 years or so, people have disregarded that. But actually, I think now what we're seeing is actually a mistake to disregard that, because when you then add these other dislocating factors, the external ones, some of the internal ones together, and the fact that India, and this is an important statistic as well, 2 years ago, India was the largest component of the MSCI Global Emerging Markets Index. It was about 25%. It had actually overtaken China. But now there are no Indian companies in the top 10 in terms of the companies within that index. And India's gone down again to somewhere between 10 and 15%. whereas China's recovered, but also Taiwan and Korea have taken up much bigger shares because of that huge expansion in market capital, which we referred to previously. So there's a lot of different elements in the mix here, and I think my own view on this, for what it's worth, as somebody who's watched India and been involved in investing in India for quite a long time, is that it's actually at times like this when everyone is quite concerned and negative that you can actually do pretty well. But I can't guarantee that is what will happen. And I don't know whether we're at the bottom yet. I think there may well be more to go.
So I want to quote a very good investor who has made a lot of money in the Indian markets. He takes the view that the FIIs or the FPIs, whatever you want to call them, foreign institutional investors or foreign portfolio investors, have been cashing out. And the Indian middle class with its SIPs,
correct,
which basically is a monthly investment plan. You just put that money in the stock market, have been left holding a ticking bomb.
Right.
And he expects a mother of all crashes.
Yes.
He expects the middle class to be eviscerated, and he plans to go back and buy assets then. He's all cash right now.
Yes.
And that is not just him, but actually quite a few of the smart Alex or smart money is waiting for a crash with a sense of foreboding. Do you have a similar sense of foreboding?
I don't have quite that strong a sense of foreboding. I do say that there could be further pain because, you have seen that exactly right. That sort of flow that has underpinned the market. It's also underpinned by the way the IPO market in India, which has been phenomenally successful until recently, where things have started to slow down. And for I think at least 2 years, India was second only to the US in terms of the size of its IPO market, and in fact bigger in terms of the number of IPOs, but not the value. That is slowing down, which is also a sign of concern. I think it is a worry when the domestic investor is left holding, whether you call it the baby or the bomb, whatever way you want to sort of look at it, that could be an issue. But I still feel the underlying fundamentals of the Indian economy are still reasonably robust.
I see. So that may be so, but foreign direct investment has vanished. Foreign institutional investors have also pulled out. And whilst in the long run, you may say in 20 years, India will grow, but there very well could be a moment of correction wherein the stock market tumbles, the rupee tumbles, and there is indeed the specter of a balance of payments crisis. Unlike Japan, India did not have or did not prepare with high reserves. India was caught with its pants down, or in the words of another investor, Indians, the tide went out and Indians were caught swimming naked. Do you see a major crisis? And India always does well in a crisis, another friend pointed out. Another 1991 style reform?
I don't think we are anywhere near that at the moment. If you look at the economics of India, I mean, you had something like, I think, was it 4 months or even less in terms of reserves left, and the famous photograph of the RBI going with the gold to the bank, flying to the gold to the Bank of England, gold reserves. We're nowhere like that, and that is because of the strength of what's happened in India since that period. But what I do say is, it's not entirely wrong to say that there needs to be another raft of those types of reforms to really deal with some of these structural issues. And I think, but I don't personally envisage the tide going out and India being left in the same place that you've just referred to at the moment. I think the position is stronger than it was.
I see. One final question. One of the investors said that the persistent decline in the rupee makes it far more difficult for him to invest in India because a depreciating rupee causes depreciating rupee earnings.
Yes.
And the rupee is nearing 100. He expects it to go 120 to 130 to a dollar.
Yeah.
And given this situation, even good, solid businesses with no fault of their own are victims of the relentless slide of the currency. Would you say that is also a factor in the current crisis? Because unlike other countries with depreciating currencies, say Japan or even South Korea, which can export to the US, India is not an export-oriented economy. Indian businesses, and we will have another conversation on this, Indian businesses have historically been trading houses. They are good Marwadis who believe in a quick trade, not in long-term investment. And quite a few of them, or Gujaratis, the Ambanis and Adanis, their DNA is trading. And so you do not get that advantage of a depreciating currency in India because it's not an export-oriented economy. And so what that does, therefore, is that the businesses, Indian businesses, eventually get squeezed out of capital, and India is capital deficient. India needs capital. And recently, Indian savings have gone down too, which have historically been really strong.
Very high,
So at this moment, he foresees a major crisis, a structural crisis, not necessarily, stock market bust, but a major structural crisis wherein India will have to confront its many problems in a more creative way. Would you agree with this line of thinking?
Not entirely, because I think if you look at the rupee historically, and of course there's no guarantee, without putting too light a sort of note on it, I never forget the line from The Importance of Being Earnest, where Miss Prism says, "You may omit the chapter on the fall of the rupee, it is somewhat too sensational." That was an issue that was taking place literally in the 1900s, and not the 1900s, the 1800s, I think, even maybe. We've had historical rupee crises, not least the ones that you referred to earlier as well in 91, and then subsequently as the economy has opened up. But if you look at it, the average rate of depreciation of the rupee is more been in the sort of region of 3 to 5%. In the 90s, people used to say 10%, but it's sort of steady. So this recent fall is much greater than that.
Yes, of course.
Even more against sterling, which I sort of see from the prism of sitting in the UK. That is a worry.
I'm in Washington, D.C., and I am living in a country with a falling dollar. So to see the rupee fall against a falling dollar. Correct,
exactly.
Is worrying.
To see the pound sterling against the rupee at about 127, 128 is actually absolutely remarkable. So I'm not saying there is not a big issue there. There is an issue, and I think that they are. The government is acting on it, and I think this is one of the reasons why even recently the finance minister has said they are opening to listening to foreign investors on things like the capital gains tax on equities. They've removed it on bonds. Maybe they do the same on equities. These structural issues to try and make it more attractive. But I think it goes back again. I'm sorry to keep going back to the other point, that many of these factors that play in this current fall are not in the control of India.
Yeah, I mean
They're not.
that's a very good point.
Yeah.
One very key point there is that tariffs have hurt India more than
Yes.
other countries,
Yeah.
because uh, India couldn't
Had
get a
relatively.
favorable deal with the
Yeah.
US. And you could blame Indian diplomacy. You could say that the Modi government hitched its star to the Donald Trump wagon and found that leads to a bumpy ride. And you could also say that in geopolitical terms, the competition, both Pakistan and Bangladesh played their cards better, and so did China. You can Japan certainly did. Japan prepared very, very hard for a Donald Trump 2.0 presidency. But nevertheless, that's an external shock. And
Yeah.
there have been a number of factors from tariffs to the Iran war that have hurt India. And it's not just spectacular own goals.
Yes, absolutely. And I think that's the difficult thing to. I mean, everything is difficult to deal with, but there are certain things that, unless, as you say, you can manage things diplomatically, they are out of your control. So then you have to look at the things that you can actually do stuff about, and also see, how the problem is going to work out. But my sense is that the government is alive to the need to address this, but inevitably it is always a question of balancing that up against domestic political priorities as well.
On that
And
note,
we have that problem in the UK as well.
well, I mean, next time we'll talk about the UK. The UK cannot seem to get its act together. It has soaring interest rates. Its bond prices are falling. Its debt is, I believe, it's crossed 100% of the GDP.
I think it's there or thereabouts.
Thereabouts.
Yeah.
And there is no idea how to get the sputtering British economic engine going post-Brexit. So if Indians feel morose, they should remember that their former colonial masters, who had a jolly good time traipsing around the country and civilizing the savages, are not doing that much better.
So, Atul, no comment at all on what you've just said, except to say that in this country, we would give our eye teeth for 6.5% to 7% growth. So let's remember that for India, even if the number is lower than it perhaps could be, it's still pretty good.
Yeah, but one qualifier there, I think, Indians often get too excited or too depressed. Yeah. And the important thing to remember is that it is easier to have a higher growth rate when you have demography on your side, when you have the wind of demography in your sails, lots of young people, and when you start from a lower base. A per capita income of, let's say, a little more than $2,500 a year makes it pretty easy to grow fast. Yes, India is growing relatively fast, and that's great compared to the UK, but it's also important to remember not to do too much of guerrilla type chest beating about high growth rates, because those growth rates pale in comparison to, say, Vietnam or comparable countries.
And and you have to look at the per capita and compare it with the right economies. I do get all that, but I also do say, as I've said before, we must not underplay the extent of the success and transformation that you have seen in India from that licensed Babu Raj to where we are today. And it is a multifaceted stock market with companies across all sectors. But it is not sufficiently strong in areas like hardware, particularly semiconductors and AI, which is where people are focused at the moment.
Got it. And so you see this tide reversing at some point, particularly after there is some sort of set of reforms. Ideally, a 1991 set of reforms, but
and those often do come about at times of crisis, as you've said before. Yeah.
So instead of waiting for Godot, we are waiting for a crisis.
Yes, and I studied waiting for Godot at A level, and I do know that Godot never comes.
But the crisis does.
Right.
The crisis always comes, and especially when you least expect it.
Lovely.
All right. On that note, Sam Tully, thank you. Thank you very much for your time.
Join the conversation at Fair Observer and subscribe to our YouTube channel.